have a friend who hates real estate investing. Why go through all that hassle, he says, when you can just buy a REIT? Well, as a real estate investor, I know that some of the greatest benefits of investing in real estate is the tax benefits. So how are those tax benefits translated by investing in a REIT, or are they? Today we're going to talk about that. And a REIT, Real Estate Investment Trust, is a corporation that invests in real estate with the structure that is similar to a stock. So there's many publicly traded REITs, or you can purchase a private REIT share as well through your investment advisor. But the idea is that they're kind of a hybrid between a stock, but they invest in real estate. But one of the primary drivers and what makes a REIT what it is the fact that a REIT must invest 75% of its assets in real estate and must pass 90% of its taxable income back to its investors. So this is key in order for them to maintain a tax pass-through status that is specific to a REIT structure that is permitted by the IRS. So most corporations would pay tax, like General Motors, you go buy one of their shares, they must pay tax before giving you a dividend. But with a REIT, they are exempt from paying corporate taxes by the fact that they pass all of their returns, or 90% of them, on to their investors. So if you as an investor purchase a share within a REIT, how is that taxed? So it's basically three different ways. The first is by an ordinary dividend. So you as a shareholder would receive a Form 1099 DIV, which will outlay the return that you received from your REIT investment and specify if it was intended to be treated as an ordinary dividend. So key here is the fact that an ordinary dividend from a REIT investment is taxed at your marginal tax rate, which means the rate you would normally pay on any of your other income, and also the rate that you would pay if you owned real estate directly. This is different from if you own stock in a corporation like General Motors, and that stock has a qualified dividend. Those dividends are actually taxed at a different, lower capital gains tax rate than the ordinary dividends you would receive from a REIT. The reason for that is because there's two levels of taxing happening when you receive a dividend from a company like General Motors, because they have to pay tax at the corporate level, and then you, when you receive your dividend, are then paying taxes again. So because REITs are avoiding the first level of taxes at the corporate structure, the dividends, when they're received by you, are then taxed at your regular tax rate, which may be higher than a lower qualified dividend rate. So that's number one, ordinary dividends. Number two is the capital gains. So just like any real estate investment, if the REIT sells a property with a gain, that capital gain is then passed on to you and taxed at a typical capital gains rate, which is usually going to be 15 to 20%. That's the second one. The third one is a return of capital. So this is specific to the REIT structure because the REIT is a corporation, and because of that, it cannot pass through depreciation the way that you would receive a pass-through if you invested directly in a syndication as a LP investor. So that depreciation is not passed through to you, the corporation takes it, but then because they are required to pay out 90% of the taxable income, that depreciation write-off actually creates more of a cash outlay than their taxable income. So that is actually passed back to you as the investor as a return of capital and reduces the basis in your investment until that goes down to zero. And then after that point, you would pay tax on a capital gains rate on your return of capital. So that is basically how you as an investor are receiving the benefit of that depreciation write-off that you would otherwise be receiving if you were a direct ownership real estate investor, or if you were a LP within a partner structure with a syndication. So REITs can be a great opportunity to diversify and be able to get into all different types of real estate. So you could own data centers and apartments and hotels, or even amusement parks, railways. I mean, there's quite an extensive list of opportunity for you to diversify if you're within a REIT. And it also comes with the benefit that you don't have the hassle of having to deal with multi-state tax returns. If you are owning investments out of state, that can also be something you have to deal with if you're a direct real estate owner in another state. So I hope this video brought you some value. If so, please like, share, and subscribe. And if you're looking for real estate investments within the Northeast, please reach out to us. We're happy to help.